think Microsoft
buying back shares.
Yep.
Right?
I think Microsoft has got that message. I think that you're seeing a generation of technology companies, and that's the one thing I worry about with Google, is this idea that we will spend that money however we want, doing whatever we want, versus, everything you say about the fanatic culture of management, I love. It's the capital discipline lurks in my mind is the one.
Are they going to listen
concern.
to you?
I don't think they'll listen to me.
All right. So one investment for a long-term diversified portfolio. Speaking of great ideas, what's the one thing we should all own?
Well, I mean, if you want a nice, easy one, you could buy something like the Norfolk Southern Railroad. You're going to do well. Mm-hmm. I mean, you may not do spectacularly, but you're going to do fine. I mean, you get a nice dividend yield. You can't replace the railroad, and they have coal, and it's well run. I mean, that would be a U.S. company that I think is just. And then,
so no ease of entry there.
Oh, you can't.
Right.
And it's irreplaceable.
Mm-hmm. Do you own Norfolk Southern?
Well, I would say we own Burlington Northern. And that's the one that I would pick, you see, is what
because of Berkshire.
So what I'd say is I always hate picking a stock. I think there's a Murphy's Law about it. We have maybe 40 companies that are 80 or 85% of our assets. And whenever somebody says pick one, I always think, well, there's a reason we own more than one, because there's so much uncertainty. But there's a Murphy's Law that whatever one I pick, then it seems to have a bad headline about a week later. But I think if somebody is watching and is thinking about buying one company, then I think it really has to be Berkshire. I think in Berkshire you get some exposure to financials, you get some technology now, you get the Burlington Northern Railroad, you get Geico, you get Wells Fargo, American Express,
IBM.
Right. And even though, of course, we all know that Warren's not immortal, although we're all hoping, but the valuation of the businesses altogether is reasonable, and it's a peculiar culture that is really run deeply with a sense of stewardship. So I think if anybody was going to say, I'm going to buy one stock and put it away based on your recommendation, I always pick that because in itself it's diversified and it's run by people that really think of their shareholders as having the vast majority of their worth in that single enterprise.
And David, last word to you on Berkshire, because you have been in and out of that stock over the years.
Are you a high-frequency trader?
No, actually, we own Berkshire.
You own it, but less, right, than at one point you did?
Yeah, and I think we like it, and I think it's I think you can make money. I think the thing that's so unusual now is that, again, going back to the kid in the candy store analogy, there's so much to look at, and one of the big problems for Berkshire is it's so big. And so your compound rates of return from here will probably be fine. Yeah. But, I think there's lots of, 40-cent dollar bills and Swiss francs and all kinds of other opportunities to be had. And that's why, we're optimistic.
And so your advice to individual investors would be, David?
Well, I think individual investors, if they can find an active manager that they feel comfortable with, that makes a lot of sense. If they have the ability to actually do analytical work, there's companies, by Procter & Gamble, you're going to be fine. You probably own Procter. Yields 3%, 3.5%, 4%. But I think this is a time where I think you can create a lot of value for yourself if you have the patience and the fortitude.
Patience and fortitude. So we'll leave it there. David Wintersman and Morgan Fund, great to have you on WealthTrack. And Chris Davis, it's lovely to have the two of you together from the Davis Funds. Thank you so much for being with us on WealthTrack. At the conclusion of every WealthTrack, we try to give you one piece of advice to help you build and protect your wealth over the long term. This week's action point is avoid what guest Chris Davis calls the investor behavior penalty. Now, historically, individual investors have failed miserably at timing the market and have been penalized as a result. Over the last 20 years, for instance, the average stock investor has both underperformed the market and stock mutual fund returns by substantial margins. The reason? They tend to buy when everyone is optimistic and stock prices are rallying, and sell when pessimism prevails and stock prices are falling. Buy high and sell low. We just heard Chris Davis and David Winters talk about the values they are finding in the highest quality global brand name companies. It's a theme we've heard repeatedly from many of our great investors, and it is a message worth listening to. Well, we hope you can join us next week. We have a gift for you for Christmas weekend. 2 blue-chip financial advisors who are offering top-notch financial planning services at very affordable prices. Cheryl Garrett and Mark Cortazzo will tell us what they are offering the little guy. And if you want to see any of our programs 2 days ahead of the regular broadcast, check out our WealthTrack premium service on our website. We are also offering exclusive podcasts with other great investors, including my most recent conversation with legendary value investor David Dreaman. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.